Thanks for joining David, Kevin, and myself for the educational video for the month of June. When Canadians think about accumulating wealth, there are two major themes that they normally talk to us about. One is investing in real estate. Two is to invest in the financial markets. Well, both of these are powerful tools in accumulating wealth, and they do work very differently. Each one comes with its own trade-offs. So which one actually performs better? I'm going to pass you over to the guys and they're going to let you know. Take care.
Before we dive in and compare returns on these two different investment types, there's some fundamental differences between the two that we wanted to go over with you first.
The first difference is the capital required in investing in real estate versus the financial market. So with real estate, typically you have to put a down payment, usually at least 5%, more traditionally 20%. And so the upfront capital required is pretty significant with real estate, anywhere in the tens, if not hundreds of thousands of dollars. By contrast, it's really easy to get started in the financial markets. Oftentimes people will use the financial markets to save up their down payment to get into real estate. You can start with as little as a few $100s and contribute a small monthly amount into the financial markets to get started.
Another key difference is liquidity. Real estate is what we refer to as an illiquid asset, meaning if you needed money tomorrow, you can't just turn around and sell your house instantly. You have to list it, negotiate a price, and there's also closing documents, and all of this could take months. Whereas the investment you have in the investment market, you can sell all or a portion of your mutual fund or ETF. In the case of an emergency, you could access all that money whenever you need.
Another difference is the effort required with these two different investment asset classes. With real estate, obviously if you own your principal residence, you're living there, so you can do the maintenance and stuff, but it still takes time. If you're managing an investment property where you're renting to a tenant, you have to deal with that tenant. Maybe they're good, bad, or somewhere in between. There's maintenance requirements. Sometimes you have to go over there in the middle of the night and fix something. With financial markets, obviously, it's a lot simpler. You just sort of sit back and let the investment do its thing. So if you're owning a mutual fund or an ETF that's investing in stocks, well, people are running those companies, but you're certainly not doing it, but you own a little piece of those companies that you invest in. So certainly a lot easier to invest in the financial markets as far as the effort required.
There's also a difference in the ongoing costs of these two different investment types. Real estate has many ongoing costs like property taxes, insurance, strata fees, utilities. All of these are costs that will likely go up over time and can eat away at your returns. Investments may also carry fees as well, like mutual fund MERs or advisor fees, but these are proportionally lower and much more predictable costs.
Another big difference between these two asset classes is the emotions and the behavioral aspect of owning these two different asset classes. With investment markets, it's often a little bit more challenging to deal with the ups and downs that we have to go through owning stocks. Obviously, the stock market reacts to news, things that are going on in the world, and the share prices react immediately and sometimes quite swiftly. Real estate can obviously fluctuate as well, but you don't get real-time updates like you do with your financial portfolio. Your RSP or TFSA, you can log into a portal, check the balance, and if it's dropped significantly in a day, you may react to that. You may sell at the wrong time. As Kevin mentioned earlier, it's not easy to liquidate real estate. It takes time. You have to list the property, find a buyer. So even if things are going poorly, you're not usually going to react swiftly and at the wrong time with real estate. So that's a benefit that real estate investors have seen over the years. Things may go through a slow period, but usually they don't make the wrong knee-jerk reaction with real estate, whereas we do unfortunately see investors make the wrong knee-jerk reactions more often in financial markets.
One of the biggest reasons that real estate can feel like such a strong investment is because you're using the power of leverage. When you go to buy a house, rarely does anybody have $1 million just sitting there to do so. You have to take out a mortgage. So you're maybe putting up 20% of the overall value with your own money, and you're leveraging the rest of the money to buy that asset. Now, when that asset grows by 5%, your returns are magnified because the bulk of it is leveraged. Now, you can also leverage in the financial markets, but the majority of people don't have the risk appetite or tolerance to do so. Even we don't recommend many of our clients leverage to invest in the financial markets unless you already have substantial net worth and high predictable level of income. So even though you can do it for both asset types, it's really more commonplace in real estate.
So now let's get to the meat and potatoes. Let's look at how these two asset classes have actually performed empirically over the past 20 years. If you look at the chart on your screen, you'll see this. If you had invested $300,000 in Canadian real estate markets, you'd have seen that investment grow to about $902,000 on average across the country. That's a 5.66% annualized return in Canada. In stronger markets like here in British Columbia, close to Vancouver, or in the GTA, your return would be closer to 6.2% per year compounded. Now, compare that to the S&P TSX Composite Index return, which represents the Canadian stock market with dividends reinvested. That same $300,000 would have grown to over $1.4 million, or an 8.14% annualized return. That's a pretty substantial difference over time. As you can see, in recent years, the growth of the housing market in Canada has been relatively flat. Compared to the Canadian financial markets, the real estate market has lagged behind in recent years. You can also see, back around the 2008 financial crisis, real estate prices did not dip as much as the stock market indexes did. So again, that speaks to the behavioral biases where most Canadians didn't leave their homes in 2008 during the financial crisis, but many investors, unfortunately, may have succumbed to their behavioral biases and sold stocks during the 2008 financial crisis. And this is really why many Canadians feel like their investments in real estate has done better than their investments in the stock market, even though it's not necessarily what the empirical data shows.
So let's run through a quick pros and cons of everything we've discussed thus far. First, we'll go with the pros of real estate. Leverage boosts returns dramatically when prices rise. It's a tangible, physical asset that feels real. Mortgage payments act like forced savings, building equity over time. And because it's hard to sell quickly, it prevents knee-jerk emotional decisions.
Real estate cons. Real estate has high upfront costs and limited liquidity, which can make access difficult. It requires time, effort, and money to maintain. And it can become a concentrated risk if your wealth is tied to one location.
Now let's go over the pros of financial investing. Historically, they have higher average returns over the long term, low cost of entry and easy to diversify, highly liquid and accessible from anywhere, and can be automated and require little effort once set up.
Financial investing cons. Emotional reactions to volatility can lead to poor decisions and potentially ultimately poor results. It's easy to do the wrong thing at the wrong time if you're not disciplined, and it requires a bit of education to feel comfortable with how markets work and to understand the investments that you own and to be successful with them. So Kevin, what's better, investing in real estate or the financial markets?
Well, even though the data we just looked at does show that investing in the financial markets does produce a higher rate of return over the long term, the actual answer is that most Canadians should do both. You need a place to live, so owning real estate does make sense, and diversifying your overall net worth by investing in the financial markets is also a good way to build wealth.
Absolutely. If you guys have any questions on the data or, your financial portfolio, your financial plan, we'd love to hear from you as always.
Take care.